Show 18 and thank you so much for tuning in. Today we have a very exciting topic. Now the RBI has deducted the repo rate by 25 basis points. It's at around 6.25% and that has happened on February 7th. It was for the first time in almost 5 years that 6 members of the MPC voted unanimously in favor of this rate cut coming in. So almost 5 years later that we are seeing a rate cut cycle that has started. Now how does this actually impact the debt mutual funds? Who is going to be benefiting the most from these cuts? And we're going to be discussing all of this with Mahendra Jajoo, Chief Investment Officer of Fixed Income at Mirae Asset Investment Managers, to understand what will this mean for debt mutual funds, fixed income side. How does this span forward? Mahendra, thank you so much for joining in with us this afternoon on CNBC TV 18. Finally we have seen the rate cut coming in now from the RBI side. How does this recent rate cut actually influence the performance of debt mutual funds? What is the past story? If you could just explain us the linkage between both of these.
So effectively, if the interest rates come down, that will have a positive impact on the NAV of the debt mutual funds because of the capital gains, and therefore the rate cut is positive for. We have to put in the perspective the background where for the last 1 year, the market participants have been anticipating a rate cut sooner or later, and in view of that, some part of this rate cut has already been discounted by the markets. However, in addition to the rate cut, the Reserve Bank has also given commitment to inject adequate liquidity into the system. Even yesterday, they have announced an increase in the OMO purchase size from 20,000 to 40,000 crores. So I would like to think that this easing measures by the Reserve Bank would be positive for the debt mutual funds because, as I explained, that the lower rates become, get converted to NAV for the debt mutual funds.
Absolutely, lower rates do surely become higher in terms for the NAVs in terms of debt mutual funds, and obviously interest rate cuts impact debt mutual funds positively. That's the word coming in there. But Mahendra, just trying to understand a bit more. Now, who significantly benefits from this? Which categories within the debt fund stands to benefit the most out of this rate reduction? Is it across board, or are there some specific categories which would see a higher benefit?
Yes, so the conventional wisdom is that higher the duration or the average maturity of the fund, the more the impact of the rate cut on those category of funds, because as per the mathematics for the bonds, the longer the maturity of the bond, higher is the duration, and therefore the per basis point impact of change in the rates is the highest. So in a theoretical perspective, the long duration funds will have benefited the most. But again, as I said, that market has been anticipating this rate cut. So in 2024, we had no rate action by the Reserve Bank, but still the long-term bonds funds have given a 10% plus return. That is because in the anticipation of the rate cut, the bond prices have moved up. So on the day of the rate cut itself, we saw little to no change in the bond yields. And now if the RBI is going to inject a lot of liquidity into the system, then I think across the curve we will see benefit. For example, there is a category called low duration, where we past tight credit situation, negative liquidity situation, the corporate bond yields are very high. The corporate bond yield curve is actually inverted. The 3-year corporate bond yield is higher than the 5-year corporate bond yield. So that category will also benefit. So just to summarize, I think the benefit will be felt across the yield curve and across the range of the debt funds. At this point, we are expecting the maximum impact on the low duration category and the long duration category. So these are the two categories which, to my mind, will enjoy the maximum dividend out of this rate cut situation.
Okay, low duration and long duration, two categories that will do well. And I just want to understand, there are gilt funds as well as dynamic bond funds. What is the impact on that as well? If you could just explain me quickly.
Yeah, so when you talk about the long duration funds, there is a bunch of funds which fall in that category. So the gilt funds, the long duration fund, the medium term fund to some extent, and then there are other some, similar sounding or similar portfolio type of funds. But when you talk about a gilt fund, without understanding what is the average maturity of the fund, it is difficult to expect or assess what will be the impact. So for example, there can be a gilt fund which has a 5-year average maturity. There can be a medium-term fund which has a 7-year maturity. There can be a dynamic bond fund where the fund manager can decide as to what should be the maturity. And take a theoretical scenario where even though RBI has cut the rate, the fund manager was not expecting a rate cut because there were a lot of people who were skeptical because of the global situation. So when you talk of the long duration fund, there is no if, no but you know exactly what to expect in the portfolio. As per the SEBI guidelines, they have to maintain a minimum duration of 10 years and so on. So therefore, if you want to remove any ambiguity or uncertainty about how the fund's portfolio will be at the time when the rate cut happens, then it is very appropriate to invest in a mandated fund. So that's why, while there are now in the similar category, I picked the long duration to have no ambiguity about what the impact.
Right. So there's no ambiguity, and that is why I would say, long duration funds is something that would see the most benefit right now. Mahendra, just taking the point forward now, does it make sense then for an investor to actually adjust their portfolios more skewed towards the long duration funds right now? How should that be a story that is going to be playing out on the debt mutual fund side then?
So there are two parts to this because every investor has a different risk profile and a different investment horizon. So I'm assuming that the investor has the risk appetite and the investment horizon. Then obviously when you're expecting the rate cuts, the weightage to the long duration fund should be the highest. And therefore, ideally, the investor should allocate the maximum possible to the long duration fund. But then there is a certain element of lag and lead effect, which, like in case of equity markets, today the market is already pricing in, let's say, FY26 or FY27 earnings. Like that, bond markets also price the likely rate cuts or the central bank action. So a lot of the action has already happened in the market. Our bond yields, let's say our 10-year bond yield at 6.65% is the lowest in the last 1 year in anticipation of the rate cut. So therefore, I think the risk is not exactly in the theoretical pattern right now because the market has already priced in. There should be a little bit of diversification of the portfolio to balance the risk, and then because of the fact that the corporate bond yield curve is inverted and RBI is on to injecting liquidity into the system, the corporate bond segment in that 1 to 3 year maturity also offers a very attractive opportunity. So it is possible that the corporate bond yields fall by 100 basis points and the long bond yields fall by, say, let's say 10 to 15 basis points from here. So from that perspective, I think in this particular situation, I would think that 60 to 75% in low duration fund, 25 to 40% in long duration fund, depending on how the investor's portfolio is. Then another case of an investor who has already been invested in long duration fund, because most analysts and the advisors have been recommending duration funds for a long time. And if he is already sitting on huge profits, then he doesn't need to do anything. He just needs to carry on and then see where the market is showing fatigue or expensive valuation, and that time lighten up. So again, for an individual investor, his situation will possibly also guide to some extent as to where he should make allocation now.
Absolutely. Mahendra, coming to you then and asking you, because you gave us an explanation in terms of how the duration changes should be made as well. What is the duration positioning of your debt funds right now? Have the recent policy, made you change anything as well? Currently, you have made any of these changes?
Look, we have been expecting the Reserve Bank to progressively get more accommodative. Our view is that this is just the beginning of the rate cut cycle, and we will see follow-up rate cuts. On top of that, the Reserve Bank will continue to inject liquidity, because if you look at the last monetary policy, even as the economy is slowing down, even as the budget is contractionary, because our fiscal deficit has fallen from 6% to 4.5% in the last 3 years, even as the government is finding it a bit challenging to spend on the capex, the Reserve Bank has projected a GDP growth of 6.7% for FY26. So, in a backdrop where the economy is slowing down, in a backdrop where the the government's fiscal policy is contractionary, if the Reserve Bank is projecting a higher GDP growth rate, it is my understanding that they are ready to be very accommodative to support that growth projection, and therefore we are very constructive even going forward on fixed income. And accordingly, most of my funds, most of our Mirae funds have been fully invested for a long time now, and we continue to remain constructive and positive on the market. So we expect that our funds will continue to be on the overweight side as far as the duration is concerned.
Right, Mahendra, I'm just going to go back to the gilt fund topic again, and talking about overall how you explained gilt funds and the role of that coming into with interest rate cuts. But are there specific risks and reward that are associated by investing in gilt funds during this period? Is it more riskier? Is what I want to just understand.
So, in case of a gilt fund, when you invest in fixed income, there are typically two types of risk. One is the interest rate risk, which can lead to volatility in the NAV, and the other is the credit risk, where if the credit defaults, then money only the government of a credit default. So, the risk that you have is the volatility risk. Now, assume you have a year bond in a, then the market rates will come down, and therefore the fund will benefit of the lower rates and capital gains. Side the RBI hikes rate or just the reverse impact will happen. There are times when the market action can be much stronger than what the investors' risk expectation or the risk tolerance are, and that volatility could lead to example, Fed cut the rates very aggressively by 100 basis points between September to December, but the US 10-year yields went up because of the other factors. And anyone who had taken exposure to the US Treasury bond funds in anticipation of the yield curve coming down, they were disappointed. So these are the unexpected risk factors which can come into play. So at this point, for example, we are struggling with a very, very volatile and unpredictable global environment. By the hour, we get the news on the new tariffs, and no one has a clear idea of whether the tariffs are going to be inflationary or the tariffs are going to be recessionary, because it also makes sense as per economic theory that if both countries hike the tariff, both the consumers will find it very difficult to, then therefore it could be recessionary. So there is a lot of, estimation and expectation factored into these prices. And therefore, if there is an exchange related issue, for example, rupee is already at the lowest, and then if the FPI is selling in the equity continue, then this necessity of some action on the external front. And those are the risks which are not factored in. We always have, as a country, a perennial risk of a weak, deficient monsoon, but not get too much into those factors, because those are the normal factors associated with fixed income volatility. But just point, the bond funds can have volatility in their.
Right. Okay, Mahendra, we'll take that note. But on that note, we're going to slip into a very short break, viewers. Don't go anywhere. We'll continue this discussion after the break as well. Welcome back and thanks for staying tuned into MF Corner on CNBC TV 18. We still have Mahendra Jajoo with us, who's describing us, the debt mutual funds. How is the impact of RBI's rate cut actually going to be impacting these funds? What is the positive impact? While Mahendra, we have spoken about those pros coming in for them, different kinds of funds, long duration, low duration funds, debt funds, gilt funds is also what we spoke about. Now, we spoke about one part was reallocating in a portfolio, maybe making some bit of a changes in the portfolio. But while doing that, if an investor is doing it by themselves, what are the risks that one should be aware of while reallocating in these portfolios in response to these rate cuts?
So one of the risk is also of missing out on the positive developments in the fixed income market. As as the famous saying goes, that risk of not investing is also a risk. So when clearly the interest rate cut cycle has started, when clearly the central bank is intent to provide adequate liquidity into the system, when the central bank is clearly determined to support growth, and when we are coming out from a interest rate hike cycle over the last 3 years from the COVID time, it's very, I think, important to have the right asset allocation, and the differentials could be very wide. Last year when everyone was so excited about the bank fixed deposits, and people were saying, we are getting very good rate in bank fixed deposits. 1 year down the line, even the liquid funds are giving 7.5% return. I don't know if any bank was offering that kind of a return for 1 year at that time. Many of the bond funds have given 10% plus return in the last 1 year. So people have missed out by being apprehensive or by not doing enough research or due diligence as to which is the best option right now. And now that the 1 year return is good, people are debating as to whether the good times will continue. So the one question which I have got asked, the maximum since the policy on February 7th, is that do you think that market is already pricing in the rate cuts? I said, look, I don't know, but then when there was no rate cut, market was obviously not pricing in at that time. So I think people, when they the debt funds, they become very, very, I think, worried or overly. The second part is that when people invest in debt mutual funds, at least this is my experience, that their expectations somehow get the re-referenced. For example, if they go to a bank and if the bank offering a 5.5% or to 6% rate on the fixed deposit for 1 year, it will is adequate. But then when they come to mutual fund, and if a liquid fund is offering a 7 to 7.5% return for the next 1 year, they feel that it is not very attractive, and possibly because when they come to mutual fund, they look at equity and then this equity is giving such high return, why debt fund should not give return. So unrealistic what they did Apple to when they were post offering 2.5% deposit. Liquid funds good return and take look what you have then in saving is increase that I consider a risk not doing a proper comparison. Obviously, there are negative risks. There is volatility. Product and good understanding of risk. Their investment horizon are important in this context.
Okay, Mahendra, if I have 100 rupees and I have to invest in the markets, equity markets clearly are in the downtrend right now. What is it that the allocation should be towards equity and debt? How much would you assign to your debt mutual fund? What are you going to tell the investor?
look, I'm a fund manager. I just manage the money I get, so I'm not the right person to advise on what should be the allocation between equity and debt. But what I can possibly make some comments on is that whatever is the allocation to debt, how should that be distributed? And there, I think, point in time, assuming that an investor is 100 rupees, and for whatever mathematics he decides to allocate 60 rupees to debt, or he decides to allocate 40 rupees to debt, that's where my part can come into play. If it was my money, I would put at this point 60 to 75% in low duration fund, and then I 65 to 40% in long duration fund. There are multiple categories, etc. So again, he can find his own spot. But in my assessment, these are the two categories which invest similar sounding funds and are the best position to take advantage of the current situation.
Absolutely best to take the advantage of this low duration, long duration. He's mentioned the allocation to that as well. Mahendra, expectations now from future of the rate, one is expecting RBI rate cuts in terms of movements are there. How should the investors start positioning themselves? Focus on that long and low duration, what you are talking about right now?
Absolutely, because look, when you are investing in fixed income, there are only two calls that you need to take. One is what interest rate risk you want to take, and what credit risk you want to take. At this point, I think the credit environment is good, but the credit pricing is not very attractive, and there is a good element of credit pricing which is very attractive at the shorter end of the curve, which is why the low duration fund gives you a good exposure to the RBI's rate cut and the tight credit spreads in the short-term market, because the banks have been struggling for deposits. Last year, the credit deposit was very strong. Now the liquidity is negative. So if all these things are going to reverse, we already know the credit growth has collapsed because of the measures taken by the regulators. We know that the RBI is injecting liquidity now, so the liquidity deficit will come normal. We know that banks are now much better in terms of their deposit growth target. The RBI has deferred the LCR requirement for at least until March 31st, 2026. So there is a lot of headroom which has suddenly got created. And today, where banks CD at almost 100 basis points spread to that situation is just waiting to get corrected. So therefore, I say low. At the long duration, obviously, if the RBI keeps cutting rate, and if the funds and the provident funds and the insurance companies continues to be strong, on top of it, if the RBI is doing open market operations, if you are taking the sweet spot in that investment term or the segment, and low duration gives you the ability to nuances. For this point, again, there are 16 debt categories in the mutual funds, and there are nuances. These two funds right now capture every.
Absolutely, Mahendra. Thank you so much for joining in with us today and beautifully explaining us the impact and what an investor should look at right now when they're looking at debt mutual funds. So thank you so much for joining. Time we have on this edition of MF Corner on CNBC TV 18. Tune again.